The 100-year bond. Why AI's debt is quietly rewriting the price of everything. In February of this year, Alphabet did something that I have turned over in my head for weeks now, and I still cannot fully shake it. It issued a bond. Nothing strange about that. Companies issue debt every day. But look at the maturity date on this one. The year 2126, 100 years from now. Let that land for a second. 2126. Every single person watching this video will be gone. Your children will be gone. Your grandchildren, in all likelihood, will be gone too. And Alphabet, a company that did not exist before 1998, stood in front of the global bond market and made a promise that stretches a full century past the lifespan of almost everyone alive to hear it. Pay you back, in full, in the year 2126. Coupon of 6.125%. And here's the part that should make you sit up. That bond was oversubscribed roughly 10 times over. Global institutions, pension funds, insurers, sovereign wealth managers were fighting each other to get a piece of a 100-year promise from a 20-something-year-old company. They couldn't get enough of it. And here's a twist that makes it stranger still. An American technology company chose to make that 100-year promise not in dollars, but in British pounds. Its first sterling bond ever. That is not a normal financing decision. That is a statement of faith. Alphabet, by reaching out across a 100-year time horizon, was telling the market one thing: the returns on artificial intelligence will keep paying for an entire century. But I am not here today to argue with you about whether AI is a bubble. That is the conversation everyone is already having. What I want to show you is something almost nobody is connecting. This single 100-year bond, together with Amazon's $54 billion debt sale, together with the roughly $700 billion in combined capital spending that the four biggest technology companies are committing this year, is traveling down a hidden chain of cause and effect. And at the end of that chain, it is quietly, methodically, rewriting the price of nearly every asset you own. Bonds, gold, the mortgage you might be about to take, the retirement account you don't think about. Most people are watching the loud story. War in the Middle East, oil prices, a new Fed chair. Those things are real and we'll get to them. But there is a second story running underneath, and it has no headline, no anchor reading it off a teleprompter, no viral thumbnail. I am going to walk you through it from the top, link by link, and by the end you'll understand why a bond that matures in 2126 might be the single most honest signal in the market right now. This is not financial advice. This is how I am thinking about the next 12 to 18 months. Take what is useful, leave what is not. So let me give you the scale first, because you cannot feel the rest of this until the size of it lands in your body. Amazon's capital spending budget this year is on the order of $200 billion. Alphabet's is somewhere between $180 and $190 billion. Microsoft has now set its number at $190 billion. A 61% jump from last year. Meta has raised its forecast to somewhere between $125 and $145 billion. Add those four together and you are looking at roughly $700 billion in a single year from four companies. I want to give you a comparison, so this isn't just a wall of numbers. $700 billion is, give or take, the entire annual economic output of Sweden. 4 American corporations in 1 year are spending more than an advanced Northern European nation produces across its whole economy. And here is the line that should genuinely stop you. This is not the peak. Alphabet's own chief financial officer said on the earnings call that capital spending in 2027 will be significantly higher than 2026. Significantly higher. So the $700 billion is not a ceiling. It's an entry price. Next year there will be more. Now sit with the obvious question, because everything that follows hangs on it. Where does $700 billion come from? If these companies could generate $700 billion in cash flow themselves, this would be a non-story. Spending your own money is your own business, but that is not the reality. They cannot cover it from what they earn. Look at the cash flow picture. Amazon's free cash flow has already cratered. Over the trailing 12 months, it has collapsed from around $38 billion to barely over $1 billion, a drop of more than 90%, and analysts project it swings outright negative for the full year. You heard that correctly, negative. Alphabet's free cash flow is projected to fall from around $73 billion last year to possibly as little as $8 billion. That is a collapse of nearly 90%. Meta and Microsoft are in better shape, but both are contracting hard. 4 companies need to spend $700 billion. The cash in their pockets, added together, falls dramatically short. So what do you do when the spending is locked in and the cash isn't there? You go to the bond market. You borrow. And borrow they did. Between February and March, Amazon and Alphabet, within a span of just a few weeks, issued more than $82 billion in corporate debt between them. Amazon did $54 billion in a single shot, one of the largest corporate debt issuances in the history of American technology. Alphabet did $32 billion, and inside that $32 billion was the piece I keep coming back to, that 100-year bond. Here is a detail that tells you how unusual this is. The last time a technology company issued 100-year debt was Motorola, back in 1997. That is nearly 30 years. By doing this, Alphabet effectively joined a strange little club, the Century Bond Club, whose members are institutions like Oxford University and the French State Power Company, entities that have, in some sense, existed for ages or are backed by a government. And there sits Alphabet, a company not yet 30 years old, issuing debt that comes due in 100 years. Now, when $82 billion of corporate debt floods into the bond market in a matter of weeks, you have to ask the question that, to me, is the single most important pivot in this entire story. Who are they borrowing that money from? Whose capital are they pulling in? Because money is not infinite, there is a pool of global savings, pensions, insurers, banks, sovereign funds, and everyone who wants to borrow has to draw from that same pool. And the moment Silicon Valley walks up to the pool with a bucket the size of $82 billion, somebody else gets less. So who is standing at that same pool? Who just got crowded out? The answer is the United States Treasury. And this is the heart of the whole thing, so stay with me. The U.S. federal government needs to issue something on the order of $2 trillion in new debt every year, just to keep functioning, just to roll over what exists and fund the deficit. That $2 trillion was already a heavy lift before any of this. And it's getting harder because the traditional buyers are stepping back. Japan has been trimming its holdings. China has been trimming its holdings. The big, reliable foreign buyers who used to absorb American debt year after year are, at the margin, retreating. So picture the scene. The Treasury already has to sell $2 trillion of bonds into a market where its biggest customers are quietly heading for the exits. And right at that moment, Silicon Valley charges in and pulls an extra several $100 billion out of the same bond market for itself. The pool is only so big. Every dollar the tech giants drink is a dollar that doesn't go into treasuries, and when the Treasury can't sell its bonds easily, it has only one tool to attract buyers. It has to offer a higher yield. It has to pay more. So look at what actually happened. The U.S. 10-year Treasury yield has climbed to around 4.67%, its highest level since the start of last year. And the 30-year yield didn't just push toward 5%, it smashed straight through it. This week, it touched 5.2%, the highest level since July of 2007, on the very eve of the global financial crisis. That is a 19-year high, the longest-dated bond the U.S. government issues just went through one of its worst sell-offs in close to 2 decades. And the people who manage real money are not betting it stops here. A Bank of America survey this week found that 62% of global fund managers expect the 30-year yield to reach 6%. Strategists at Barclays and Citigroup have warned clients it could breach 5.5%. Read that again. The smartest desks on Wall Street are looking at a 5% 30-year yield and calling it a floor, not a ceiling. And here is why this matters so far beyond the bond desk. Every single basis point that yield rises is another nail being driven into gold. Why? Because gold pays you nothing. You hold an ounce of gold for a year, and at the end of that year, it has paid you exactly 0 in interest. But that same money in a 10-year Treasury now pays you better than 4.5% to do nothing but sit there, and the 30-year pays you over 5. When yields are low, gold's lack of a coupon barely matters. But when the longest government bond on earth is paying you more than 5% risk-free, the cost of holding a metal that pays you nothing becomes glaring. Capital does what capital always does. It drains out of the asset that yields nothing and into the asset that pays you to wait. So follow the full chain now, because this is the dark line I promised you at the start. The AI arms race created a wall of capital spending. That spending blew past what the companies could fund from cash flow. The gap got plugged with a flood of corporate debt. That debt walked into the bond market and competed directly with U.S. government debt for the same limited pool of capital. That competition pushed the entire yield curve higher, and the rising yield curve systematically crushed the price of gold. This line does not appear in the headline of a single gold analysis. You will not find it on a finance channel, but it may be one of the most important drivers of gold in 2026, and it starts with a company writing a check that comes due in the year 2126. Now, at this point, a fair-minded person might push back. They might say, hold on, you are stretching this. AI companies issuing bonds and the price of gold are 100,000 miles apart. There are several markets sitting in between. Is a chain that long really holding together? That pushback is completely legitimate. So let me add a second layer and make the logic harder to dismiss. The AI capital spending is not only hitting the supply side of the bond market, it is at the very same time manufacturing inflation. And it's doing it in a way that almost nobody talks about. Microsoft said it plainly in its own earnings report. Of this year's increase in capital spending, roughly $25 billion is purely due to component prices going up. Not because they are buying more things, because the same things now cost more. Chips up, memory up, power up, cooling equipment up. Meta said the same, that the main reason it raised its capital spending number was rising memory prices. Think about what that means. The AI build-out is, by its own nature, pumping inflation into the economy. 4 companies all reaching for the same chips, the same memory, the same power capacity, the same cooling systems at the same time. That is a textbook demand shock against a fixed supply. Prices rise, and that price pressure does not stay locked inside a data center. It works its way out into the broader economy and eventually shows up in the inflation data. And it has. U.S. consumer inflation has run hot. The April reading came in at a level not seen in years, with energy doing a lot of the heavy lifting. Yes, because of the Middle East. That part is true, and I am not going to pretend otherwise. But look underneath the energy line. Airfares jumped, apparel rose. Categories that have nothing to do with the Strait of Hormuz climbed too, and what they reflect is supply chain cost and component price pass-through. So the dark line is not a single-barrel attack on gold. It is a double-barrel attack. On one side, the corporate debt flood pushes the yield curve up directly, which pressures gold. On the other side, AI's component inflation feeds the inflation data, which keeps the Fed hawkish, which keeps real rates elevated, which pressures gold again. Gold takes a punch from the left and a punch from the right, and the fist on both sides belongs to the same body, the AI build-out. And there is a third punch because the same AI story that is hammering gold is also lifting equities, lifting risk appetite, pulling capital toward the most exciting trade on Earth. When everyone is chasing the AI rally, who wants to park money in a lump of metal that produces no income? Gold gets abandoned not because anything about gold has changed, but because the AI build-out is starving it of attention, starving it of yield competitiveness, and starving it of safe haven demand all at once. Now, I want to take you to the company sitting at the dead center of all of this, Nvidia, because there is a signal so buried in its most recent earnings, and it is hiding inside what looks, on the surface, like spectacular good news. The headline numbers were a triumph. Record revenue of $81.6 billion, up 85% from a year ago. Earnings per share of $1.87, beating the street's $1.77. Next quarter guidance of around $91 billion. Well above what analysts had modeled. And on top of it, Nvidia announced a new $80 billion buyback program and raised its quarterly dividend from 1 cent a share to 25 cents, a 2,400% increase in the dividend. By every textbook, that is a blowout. So here is the question that should bother you. Why did the stock slide after hours instead of soaring, drifting down around 2% on what, by the headline numbers, was a record-shattering quarter? This was not a one-off. This was the fourth straight earnings report where Nvidia beat expectations and then gave background after the print. The one before this, the stock fell 5% after a beat. Before that, 3%. Before that, under 1%. 4 times in a row. A company that has beaten expectations in 18 of its last 20 quarters, and the market's reaction keeps getting colder. That is not the market being irrational. It is exactly the opposite. The market is being brutally rational. It is telling you something. It is telling you that the current valuation has already eaten the next 3 years of growth. Every beat now just confirms an assumption that was already priced in. It doesn't create new upside. Your grades are excellent, but you only met the standard I already set for you. But the thing that actually grabbed me was not the stock reaction. It was that $80 billion buyback and the 2,400% dividend hike. Ask yourself a simple question. When does a company start handing large amounts of cash back to shareholders instead of plowing every dollar into expansion? It happens when management's confidence in the marginal return on reinvestment begins, very subtly, to shift. Not because the company stopped making money. Nvidia is making money hand over fist. But the posture changed. From full speed ahead attack to attacking with one hand while paying a dividend with the other. That shift in stance carries a meaning. There's a small human detail from the earnings call that I can't stop thinking about. The CFO said the dividend was rising to 20 cents. The CEO, Jensen Huang, corrected her on the spot. He said it's 25 cents. And then he made a joke. He said something to the effect of, that 5 cents might really matter to our shareholders. The room laughed, but sit with that for a moment. When even the founder starts caring about the dividend down to the nickel, that drift in attention is, itself, a signal. Now, I am going to be honest with you, the way the lazy version of this story never is. I am not telling you Nvidia is the next Cisco, but the comparison is worth holding in your hand. In March of 2000, Cisco was the most valuable company on earth. Beat after beat, Wall Street in love. And then Cisco began aggressive buybacks. Then the internet bubble broke. Cisco's stock, to this day, has never returned to that peak. The difference, and it is a real difference, is that Nvidia has actual revenue, actual profit, actual customer demand. This is not a PowerPoint company from the year 2000, so please don't hear me saying it's a fraud, it isn't. But Goldman published a number that genuinely makes me uncomfortable. If 2026 technology capital spending reaches $700 billion, then that spending, as a share of US GDP, has now reached parity with the peak of the dot-com investment frenzy of 1999 to 2000. Parity with the peak. And here is the principle I want you to take from that. Sometimes the problem of pace is more dangerous than the problem of direction. The direction can be exactly right. AI can be the real thing, the genuine revolution, and the speed can still be so fast, so far ahead of itself, that the outcome looks a lot like having been wrong. You can be driving toward the right city and still wreck the car by taking the on-ramp at 140 miles an hour. And I want to step sideways for a moment, because to really understand what is going on, you have to understand the two faces of this technology. And there is a conversation that exposes both of them better than anything I've seen. Earlier this year, at a major industry event, Sam Altman of OpenAI and Patrick Collison of Stripe sat on a stage together. And the things they said, almost casually, tell you everything about why the smartest, most aggressive people in technology are pouring oceans of capital into this. They talked about AI being on the verge of curing complex disease, the kind of multi-gene, multi-factor illness that humanity has never once fully cured. Cancer, Alzheimer's. They talked about a biology model, trained the way a language model is trained, except instead of swallowing human text, it swallowed DNA sequences and protein structures, learning to predict the next genetic fragment the way ChatGPT predicts the next word. They talked about AI collapsing a drug discovery process that used to take 10 years and billions of dollars into something that might take a year, or even months. Altman talked about material science, about fusion power within 5 years. Not because scientists suddenly got smarter, but because the monstrous electricity demand of AI data centers is dragging fusion forward by brute economic force. And he described his ultimate business model with a phrase I find genuinely haunting. The intelligence meter, like the water meter or the electricity meter on the wall of your house. OpenAI doesn't want to build flashy consumer products, he said. It wants to put a meter on the wall. You plug in, intelligence flows out like tap water, and at the end of the month they bill you for what you used. Tie their fortunes to the productivity of all of human economic activity. And then there was the detail that put a chill down my spine. To celebrate a major model release, the OpenAI team decided to throw a party. And Altman, on a whim, asked the model itself how it wanted its own party run. The answer wasn't a dry list of party planning templates. It picked a date for a pun. It asked for the toasts to be kept short. It refused to give a speech itself and insisted that the human engineers, the people who actually built it, stand in the spotlight instead. And it asked for a suggestion box in the middle of the room to collect ideas for how to improve the next version, and asked that all of those suggestions be fed back to it. Read that again. That is not text generation. That is a thing made of silicon and code displaying humor, displaying humility, displaying something that looks unnervingly like a social conscience. Even Altman admitted he felt a strange, inexplicable moral pressure standing in front of it. So here is why I'm telling you about a party. Because this is the first face of AI, the face of abundance, cures, fusion, intelligence flowing like water, a new era of prosperity. It is genuinely intoxicating, and it may even be true. But there is a second face, and the second face is the one that issues a 100-year bond, burns through a northern European nation's entire GDP in 12 months, drinks the bond market dry, and forces the yield on every government's debt to climb. The same intelligence that promises a deflationary paradise is, right now, in this moment, the single most capital-hungry, inflation-generating construction project in human history. And here is the punchline that I need you to really absorb. The market is paying for the second phase today. Cash up front, real bonds, real interest, real pressure on real yields right now. The first phase, the cures, the abundance, the deflationary miracle, arrives years from now, if it arrives at all. The bill comes due now. The blessing comes due later. That mismatch, that timing gap between when you pay and when you get paid, is the entire risk sitting underneath this market. And if you want to see what it looks like when that bill finally lands, you don't have to imagine it. One country is already living it. I'm not going to spend long on Japan, because the real lesson of Japan isn't the one most people draw. But I do need to show you one thing, because Japan just did something that, on its surface, looks like nothing. And underneath, it's a warning. Recently in Japan, a quiet, deeply unusual thing happened. The yield on Japan's 10-year government bond rose above the dividend yield of its main stock index. I know how that sounds. Bond yield, dividend yield, a fraction of a percentage point. Who cares? But here is why it matters, and it has nothing to do with the headline number. For 30 years, Japanese money had no choice. Interest rates were pinned at zero, sometimes below zero. Bonds paid nothing, so Japanese capital, the pensions, the insurers, the banks, was forced out into the world, forced to buy stocks, forced to buy U.S. treasuries, forced to take risk, because sitting in cash or domestic bonds earned them precisely nothing. For 3 decades, the entire planet enjoyed a hidden subsidy. Japan supplied the cheap money, and risk assets everywhere enjoyed the premium. And now, for the first time in a generation, that money has a choice again. The bond pays something. Cash is no longer worthless. So the most important thing that happened in Japan is not that a bond yield crossed a stock yield. It is that Japanese capital has, for the first time in 30 years, regained the right to say no, the right to not chase the stock, the right to not buy the treasury, the right to come home. That is the whole point. Japan didn't crash. Japan is not the story because it's about to collapse. Japan is the story because it is the first developed nation where the era of cheap money visibly ended, where money got its choice back. And when money everywhere gets its choice back, every risk asset on earth has to become humble. It has to re-justify its price to an investor who, for the first time in a generation, has somewhere safe to put cash and earn a real return. Japan simply hit that wall first, because its debt was the highest and its rates were the lowest. Behind Japan's wall is the same wall every heavily indebted nation is leaning on. Japan is not the exception. Japan is the preview. So let me pull this all the way back and reframe the entire thing, because I think most people are asking the wrong question. They're asking, is gold in trouble? Is Japan in trouble? Is AI a bubble? Those are all the wrong question, or rather, they are small pieces of a much bigger one. The right question is this. For 15 years, the entire global financial system ran on one assumption, that money would always be cheap. Rates near zero, capital everywhere, valuations that could float on a story, because there was no cost to holding the story and no safe alternative that paid you to wait. Every asset you own, every valuation you've gotten used to, was built on that one foundation. And what the dark line is telling you, what the 100-year bond, the debt flood, the rising yield curve, and Japan's quiet little signal are all telling you in unison, is that the foundation is cracking, not collapsing in a single dramatic day, cracking, slowly, structurally, in a way that doesn't make the evening news. Because here is the truth that connects all of it. AI was sold to us as the force that would make everything cheaper, and one day it may. But the path to that cheaper future runs directly through the most expensive construction project in the history of the human race. To get to the world where intelligence is free, somebody first has to spend $700 billion a year, then more the year after, and the only way to fund that is to borrow it, which means draining the world's savings, which means raising the cost of money for everyone, everywhere. The very technology that promises to end the age of scarcity is, in the act of being built, ending the age of cheap money. And when money stops being cheap, every single asset that was propped up by cheap money has to do something it hasn't had to do in 15 years. It has to prove all over again that it's actually worth the price. The stock that floated on a story now has to show cash flow. The bond that paid nothing now competes with bonds that pay something. The gold that yielded 0 now sits across the table from a treasury yielding 5. The house that only ever went up now answers to a mortgage rate that won't come back down. Everything that was lifted by the tide of free money now has to learn to swim. That is the real repricing, not of one asset, of the entire idea that money is free. So I'll leave you where I started. A company that did not exist 30 years ago issued a bond that comes due in the year 2126, a 100-year promise to pay, to fund machines that it swears will be paying off for a century. And maybe they will. Maybe in 2026, someone will look back and say it was the smartest debt ever issued. But the bond market just slipped a note to the rest of the world, and the note has one sentence written on it. Money is not as cheap as it used to be, and once money is no longer cheap, the only assets left standing will be the ones that can survive the bill coming due, not in 100 years, but right now. The real question was never whether AI pays off across the next 100 years. It's whether your portfolio survives the next 100 weeks while the check clears. The pieces are on the board. Whether you see the dark line or keep watching the headline is, in the end, the only edge you actually have. This video is for educational and entertainment purposes only and does not constitute investment advice. Markets carry risk. All decisions should be based on your own financial situation and risk tolerance.